Welcome to Sharks, Snakes and Shareholders, an Innovators Uncensored show where startup founders and entrepreneurs share their horror stories of shady term sheets, toxic boardrooms, and investors you wish you declined. Each week we'll have a new guest, ranging from angel investors and VCs to deal makers and founders, who will rank each of these horror stories on our investor red flag scale. Hosted by ShipShape.VC's very own Daniel Salko.
Hi, I'm Daniel Safko. I'm the CEO and co-founder of ShipShape.VC, a free-to-use investment search engine that enables founders to identify which investors they should be speaking with about the technology that they're building. We're really pleased about this show because it helps founders identify the horror stories that other founders have gone through without needing to repeat the same mistakes themselves. Welcome, Cai Gwinutt. Co-founder of OpenMove, you also have spent a lot of time in the Welsh tech ecosystem. You work on the technical due diligence front as well for a number of funds. You've seen a lot of hairy situations that founders have been in, and you can also sort of talk to what's driving funds as well. It is fantastic to have you here with us today.
Thank you, Daniel.
What have I not covered? What would you like to say?
I'd add some great sort of situations for founders as well. They're not all bad. And yeah, you're right. Like the Welsh ecosystem is brilliant in that it's relatively small, and we all know each other. And I'm looking forward to having a great conversation.
Brilliant. And for those who are joining us for the first time, I just want to go through the ranking system that we've got and essentially the format that we've got for the podcast. So I have in front of me 3 founder-submitted horror stories of scenarios that they've been in where essentially things haven't gone well, either at the starting point of engaging an investor or as they go through a process. And there's some really nasty situations, unfortunately, that founders go through. The idea of the podcast really is that we help founders who are maybe doing things for the first time build up pattern recognition from the experiences of others so that they can maybe avoid making the same errors. We have a ranking system. So we actually go through these stories, we talk about them for a little bit, and then we've basically got 4 different categories. So we've got the oddball alert. So that's the lowest tier. So oddball alert is when you just find something a little bit weird. The person who's potentially going to write you a 1K check but asks 100 questions for due diligence.
We all know those.
We do know those. Next up, we have the backseat founder. So backseat founder does what it says on the tin. They try and basically run the business as if they're the ones who actually came up with the idea. Next, we have boardroom vampire. So they're going to just eat all of your time. They're going to get involved in the actual running of the business, eat up your capacity, and essentially not help grow the business. Lastly, we have business butcher. So this is where you potentially engage with an investor, and if you signed up to the terms that are on offer, you've killed the business.
Yeah. Okay. I've got it.
Cool. Brilliant. And feel free to bring in your own experiences. That's always very helpful. Okay. So let me just reorder these. Ready for first?
Let's go for it. Let's jump straight in.
Awesome. Okay. I had one investor promise to lead around. They signed term sheets and then just went AWOL. So investor eventually got back in touch and sort of gave excuse after excuse as to why essentially the things hadn't been completed from their end. And I think lucky for this founder, they then had the founder of a reputable legal tech company phone up, get in touch and share that same investor had been involved in another company's round. And unfortunately, in the other instance, that company had gone into liquidation, essentially on that promise being empty.
Okay. So we've got is this a first-time founder, presumably?
We won't disclose. We won't disclose.
Okay,
we won't disclose. Yeah. Funnily enough, this actually is really so. I didn't submit this one, but could quite easily have done. Only we didn't have the knight in shining armor riding in at the end. We had to figure out ourselves.
There's 2 parts to this, isn't there? The first part is an investor making a promise and then that not coming through, and then the knight in shining armor at the end, which is rare.
Very rare. Yeah.
And I mean, if I got £1 for every time a founder says, an investor said they're going to invest and then they don't, I think we'd be quite wealthy. It's a little bit like when a founder says, we're just about to sign our first enterprise deal, and that sometimes takes a lot longer than anyone was planning.
Almost always.
Yeah,
And you hear it from you hear it from founders that are perhaps further down that journey than others. Like, until the money's in the bank account, this isn't done.
Yeah.
And like, I think this is a classic example of that. Like, even term sheets, even the legal documentation, everything being signed doesn't mean that the deal has actually happened, because actually, where's the founder's legal ability to go and pursue that? Like, if you're a founder and you're completing a funding round, it means that you don't have much cash usually, like not enough to go hire a lawyer to go chase this down.
Exactly. And, worth mentioning as well that from the founder's perspective, like, don't complete your paperwork until the cash is in the bank.
Yeah, I think that's a really good point. Actually, Alistair and I were discussing this the other day about the number of documents that. So Alistair, my co-founder, about the number of documents that we used to pen on our side and then go and send for someone else to sign on the other side. And actually, in theory, someone could have just taken that document and got someone else to sign it.
Which is it's a massive risk, right? Obviously, some of the online platforms make that a little bit easier, but there's no real escrow. Kind of reminds me, without wanting to plug it, but with OpenMove, we're looking at property transactions, and it's kind of crazy, like how much money moves hands there on still like part signed documents and stuff sometimes. But anyway, that's a different story. The knight in shining armor, we need more of those. I think the US ecosystem, there's a couple of those individuals, and there's a couple of well-known incubators who are very good at saying, don't deal with that investor. They're known to be a shark.
YC have got something like that, haven't they? Where they,
exactly what I'm thinking about.
Yeah. Which I think is fantastic, because actually, founders very often are going through things for the first time. And if you can build up that knowledge base of essentially what the ecosystem, or at least a very significant part of an ecosystem, thinks about those types of interactions, I think it's so helpful. And definitely we would have benefited massively from having greater awareness and almost crowdsourcing of that type of intelligence.
Yeah, definitely. I suppose for any founders listening, the thing is to speak to other founders in the ecosystem. And if you're talking to an investor, ask to speak to their portfolio. If they're a good investor and they're well behaved and they're well intentioned, then they're going to try and shove that portfolio in front of you, and they're going to say, speak to the other people I've invested in. They'll only say good things about me, and that's what you want.
And one of the things that I've also done previously is try and identify the portfolio. So if you know the name of the individual, you can look on Companies House, see what they're potentially involved in, and look at filings, and actually trying to take one introduction from the investor in terms of portfolio company that they potentially have handpicked to give a good review, but also go and ask another one if you can.
Yeah.
Because they haven't been sort of handpicked for the review that they're going to give.
I think that's a very fair point.
Awesome. Okay. What could the founder have done differently in this process to potentially, if not, there's no way they could have avoided this scenario, possibly, but perhaps they could have brought forward the point in time when they found out about this, or when they at least sort of like pushed the investor to basically,
I think it's
bleep or get off the pot. We're not allowed to swear yet, so
I think it's really important to put sort of deadlines on things, or expectations around, we're going to close this round, at the end of March or whatever. And if things are starting to drag, and communication is poor, and because closing a deal, it's not going to happen overnight necessarily. There's this lovely idea that you go and pitch, and the investor sat there with a checkbook in their pocket, they take it out, and that doesn't happen for the most part anymore. But yeah, like, set a deadline, and as you start to approach that deadline and things are not working, your confidence in closing that deal probably starts to tend towards zero. And hopefully, that's not your angel, not your lead investor. If your lead investor has bad comms, then you probably need to go and find another lead investor.
So the start of this scenario actually happened to us as a company as well. I think one of the things that we were most afraid of was the lead of a round essentially not being true to their word, and then having to start from scratch again. What would you like? What can a founder do? What's a sensible step for them to go through in terms of, okay, actually, your lead isn't being the cornerstone that they need to be?
Yeah, you don't want a first-time lead, and you don't want a sketchy lead, right? So again, it's about meeting other startups in your ecosystem, in your your cohort, your group, or word of mouth, friends of friends, and ultimately trying to find an investor who people have dealt with previously. If you can find one of those, and I appreciate it, this is such a difficult thing, raising money at the best of times, but if you can find that person or that firm or whatever, then at least you're more likely to get that traction and get to the end. Whereas if some rogue person who turns up and says, oh yeah, I'm going to do this, then I'd say the confidence is a little bit less.
And that's definitely something that I think, being a few years into this now, I would go and ask others about whether or not they had ever come across that individual before, and I'd take it as a significant sort of flag if no one had, because reputation counts for a lot, and an investor that says that they're going to lead around and is well known in the ecosystem is going to have that collateral damage, but actually an investor that isn't well known in the ecosystem actually won't have the same extent of collateral damage. Like that for me now would be a significant flag if no one else had heard of a lead.
So the number of people in the UK who claimed SEIS tax relief last year is in the thousands. This is where we need a fact-checking system. But I think the angel sort of community is pretty small, and people do co-invest together. So it's not like a N of 6 trying to find like your way through that network. There's probably one or two people you need to talk to in order to get a pretty good idea of what you're talking about.
Just think about this from the founder's perspective too, right? So let's say you pick this up, you know that this lead essentially is not going to be able to act as a lead for your round.
Mm-hmm.
I think, again, one of the things that I was afraid of was communicating with the other people that were participating in the round to say, actually, look, this is not happening. Are you still happy to go ahead?
That's a great question. And for the most part, the answer will be yes, because, again, everyone's seen this sort of activity and this behavior, and they'll just say, oh yeah, okay, fine, like that's happened. The only time that's maybe going to be a really big problem is if you have a particularly niche product and that investor is in that particular niche and they were providing a massive amount of credibility for your product or route to market or something. But I don't think that's what we're talking about here.
Yeah, it doesn't sound like it. And I think also one of the other things is, even if the round doesn't go ahead and your business ends up folding, all those people who were involved in that potential funding round will remember how you've played it too. And so if you do go again, actually you've got a reputation intact, and actually not just a reputation intact, like you probably come out of it smelling pretty good, because you've played that with integrity.
Yeah, definitely. And then let's talk a bit about that knight in shining armor as well. Important for those people involved in the transaction who have a bit more experience perhaps, to actually call this sort of stuff out when they do see it, and to also reach out to fans and say, look, in my honest opinion, based on what I've seen previously, this doesn't quite smell right. So perhaps we need to put a bit of caution into it. And, it's just that coaching of like, especially first-time founders.
So well-known UK-based legal tech founder, you know who you are. Thank you. Okay, I think let's go on to the reviewing of that particular scenario.
These are quite. It feels like we're going from 0 to 1 really quickly.
Yeah, it does.
Yeah, okay. I'm kind of torn on this.
Yeah, me too.
As a call, because part of me just wants to say
oddball alert.
This is an oddball.
Yeah, if you catch it early enough.
If you catch it early enough, yeah. In this case, it could have been like catastrophic, and obviously for the other startup, it was.
It was. Yeah.
So I suppose what we're saying is, like, founders, it's on you for not to make it like this,
Yeah.
but to make it like this.
Yeah.
Speak to one another, get good advice and stuff.
Yeah. I mean, it should be that. Hopefully it didn't get to that.
Yeah.
Obviously it did for someone else. So I think this scenario could quite easily have been that.
Yeah.
But I think
We're gonna
actually, yeah, I'm gonna go.
I'm
with
tending
that.
to agree with you on that. Yeah.
And I think actually that also speaks to the role of that knight in shining armor.
Yeah.
Coming out and making sure that actually it didn't turn into that.
Great message there. Surround yourself with great people because they'll turn that into that.
Yeah. There we
go.
are.
There's our advice.
Right. I think we're done, Rich. On to number 2. All right. Common enough scenario. We weren't yet profitable as a business, and an investor who came through via SCIS was also asking to draw a salary from the business.
Right.
Again, this is oddly, I've seen this behavior before. Having already received their SCIS tax relief and the business being super early, it would have been detrimental, essentially, to that business. But for the investor, they were going to be in essentially net profit from the terms of their salary and the tax relief that they were receiving.
Yeah.
Seen that one before?
Yeah. You certainly wouldn't want an investor taking out more than they put into the business.
I mean, that for the investor, that's the whole idea.
Eventually. Sorry. Yeah. Is this how that works?
I've been doing it wrong.
Brilliant.
But I mean, so the investors definitely think about, okay, when am I going to get my return? This type of arrangement for them is like, okay, I get to make a return super early on this, and there's potentially added upside down the road in terms of helping the value of the equity grow.
Look, if someone's adding value to the business, they deserve to be, remunerated in some sense for it. If the business is pre-revenue, then ultimately it's a long play, and that's the whole point of investing in early stage companies, right? You're betting on something that should be big, hopefully one day, but today it's nothing, and it's going to need a lot of love and a lot of care. I'd love to be able to go out, all day long and invoice day rates that I give to other people to founders, but that just wouldn't work in anybody's interest, is the reality. The individual here, I feel like there is a little way of playing the system. I'm not saying they were doing this, where there's definitely an arrangement where you could almost do investments on a credit card. If you could take the money back out, and with SCIS and everything else, it's so low risk that you would almost do it on a credit card.
Yeah.
I would suggest to any founder, if that's what your investor is looking at or trying to do, they're not in it for the long run with you. They're in it for themselves in the short run.
And also think about it from a founder perspective. If someone's giving you capital, you've usually got a pretty good idea of where you think the next best pound dollar spent is going to be. And if it's not them, don't do it, because ultimately, unless you would think that individual is the next best pound spent, like that's just the wrong framework through which to view it. And I think speaks to the sort of the power dynamics at play as well between
massively so. And my assumption here is we're talking about an early stage company. We're talking pre-revenue.
Yeah, pre-revenue.
Obviously, as you get later through this, then it becomes far more normal. And there's reason for that. If you're gearing up to an exit, if you're looking to IPO, you're going to need to bring a whole load of people onto the board that actually understand that process and can get the business ready for it. And you're going to pay money for that because professionals want to be remunerated, rightly so. But in the early days, it's a bit of a sharky behavior, isn't it?
And I definitely know by reputation there are quite a lot of people in the ecosystem that do that with founders, where they will invest, let's say it's 20K, and they'll draw down essentially an advisory sort of salary or fee every single month for the next year. And actually they end up quids in as well post SCIS tax relief. And it just feels wrong. But also thinking about this from the other angle, if you're a founder and you enter into one of these arrangements and you essentially go into a later stage funding round, and someone does really in-depth DD about not just your cap table, but also the contracts and the advisory contracts that you have.
Yeah.
This is going to smell really off to that investor, and you could potentially risk that deal happening because of ultimately your decision making as a founder being called into question.
Yeah, 100%, right. And it's all, managing that cash flow. And as you say, a founder should, not necessarily always does know the next best place to spend £1. I think everyone spent a bit too much money on LinkedIn ads or something like that at some point. And, that maybe doesn't work either. But yeah, I think that's what we're saying. Go back to the DD bit. I missed your question there. I feel like there's something I could pick up on.
Yes. So the DD bit being around, in future, an investor is going to examine your business, and they are potentially going to look through your documentation, and they might join the dots between those who are on your cap table, the timing of that, and then the timing of, let's say, a contract with an advisor, and be able to say, well, actually, that person invested 20 grand, but they actually have drawn down that entire 20 in the course of a year, let's say.
Yeah. So on that point as well, when the next round happens, something that might need to happen is just cleaning the cap table up a little bit. And I'd suggest that might be a situation where a bigger investor, a more experienced investor, comes in. It creates work for them in terms of having to clean that up. And
what do you mean by cleaning up the cap table? Like, I know what it is, but many of the people listening may not. Yeah.
So sometimes some of the early investors or some of the people who've got themselves onto cap tables early doors, let's say, now need to be exited from the cap table for various reasons. And there's lots of different reasons for why that may need to happen. Big established funds are very good at doing that work. But it is work, again, that they're going to have to go through. And it doesn't necessarily turn them away from the deal, but it just means they need to be thinking about putting a bit more resource into the deal than they would need to otherwise.
So talking about potentially those funds buying those individuals out of that scenario?
I mean, generally, that's the easiest way to get rid of them, right?
Yeah. And who doesn't like making a nice return? And hopefully everyone parts ways as friends. And indeed, that founder walks away wiser.
Yeah.
Okay, brilliant. I think probably let's see where we rank this.
Yeah, good.
Yeah, I think I go with
oddball.
Yeah.
I really dislike this behavior.
I don't think it kills the business though.
I don't know. I think it can do. Okay.
Well, yeah.
Well, maybe I'll go to orange then.
Yeah.
But I just think it's fundamentally dishonest in a way. And it's not in the spirit of the game of, like, we're trying to create more startups. We're trying to make an environment where more people want to build startups. And this sort of behavior, which is just a bit kind of dissuades people, I think.
I agree. And I can see how it might, in certain scenarios, reduce the optionality that the business has, because you might not get a top tier investor on board because of the signal that you have sent in making that decision earlier. I just don't think it necessarily prevents lots of other paths for the business. I don't think it kills the business by entering into a deal like that. And I think if you're a founder and you're desperate for cash, and you in theory know that 20 grand today you can turn into 60 within 4 or 5 months, actually that then is, granted, it's a ludicrous credit card debt that you're going to be paying off for a year, essentially, and it's not genuinely an investment. And I think probably from an ethical perspective, if there's an investor coming in with those terms, and you're not giving other investors coming in to the round the same terms, then you're actually doing every other investor a significant disservice.
Absolutely. Have you brought the credit card machine? Like, I'm happy to.
Yeah, I think it's so easy for founders to get into that, right? Because
It's really hard. You talk about that, that really good point of if you need to just get money into the business, it's an incredible amount of pressure. And I think that's something we don't talk about enough, is not just the runway in the business, but like the personal runway of the founder and how they can extend that and make life easier. And, as we go through life, that becomes easier and easier and easier. But it is like a huge problem, and you end up making decisions that you otherwise wouldn't make if there was just a bit more of like a leeway or something for founders.
I think many founders going into these types of scenarios probably think, oh, that will never be me. I definitely...
And that's a positive signal, isn't it? Like that ridiculous optimism.
Yeah,
it's like the core part of being a founder.
I still wake up that way, like, and then I remember.
That's great. Cool.
I think on story number 3. So my upside down reading skills aren't what they were. Okay, our first angel came in as part of a VC angel program. They'd signed all of the papers knowing that they'd just kicked off the round. 2 months later, that sort of VC angel said that they were taking too long and withdrew that commitment.
2 months later?
Yeah. From the start of the round.
It's pretty impatient. I suppose they were part of an angel program, though. So was the angel like a first-time angel as well? Is that what we're dealing with here?
So VC angel programs very often do go for like first-time angels.
Yeah.
And I guess they've also got their own stipulations, right, in terms of like you can have this much, but it might be use it or lose it.
Yeah.
In terms of whatever access they've got.
It's a tough one. So the round just wasn't closed completely anyway. Again, this is a little bit like the first question in terms of it's just people not doing what they said they're going to do or changing their mind halfway. It happens all of the time. And it's incredibly frustrating. It is very frustrating. But it does speak again to the importance of working with with investors who have good experience, have been through it. They'll generally have a little bit more patience. And they know that things are not going to happen like this. Is there anything the founder could have done differently though?
I mean, I think setting expectations is always quite difficult because you sort of walk the tightrope of giving yourself enough flexibility so that if timelines do drag and out to the right, which they always do, that actually that's been communicated effectively to the investor and actually updating as you're going through, right? I think definitely something that gotten better at is if we've got key participants in a round, keeping everyone up to date as to like, okay, well, actually we're still waiting on this, or here's the next step, and we anticipate it's going to be done by X.
Comms is so important, and I'm the worst. Like I will just go dark for like days or like a week, and in my head I'm like, if there's no communication, then everything's fine. But you really, really should do like good communication and updates. And I'm lucky in that Ross is brilliant at that. To the point I'm like, why is he telling people this again? We literally talked about this last week. But that's really important. And so work out which one of the founding team is the best at that and get them to focus on it is what I'm saying. And then, setting that expectation and setting it through. And what should never happen is someone just surprising you and putting, like, if they surprise you, then there's some external factor that's happened. Like their roof has just blown off and they're like, oh, the money I was going to invest in your company, I now need to go and spend on a roof. I don't know if that's ever happened, but it's a very visual idea, isn't it?
But actually that happens. And actually that I think there's something in that, right? Which is, the old adage of time kills deals is true because actually downside adverse impact happens to everyone.
Yeah.
And over a long enough timeline, it's going to happen. And therefore, like the cash position of your prospective investors will be affected both up and down, but you might not capture the upside, but you'll almost certainly capture the downside ones.
Yeah. And the other part is like the whole FOMO thing. Even amongst the most like storied investors, FOMO is a thing. Like if everyone else is piling in, they're like, maybe I should be piling into that. And it's much easier to build FOMO over a short period of time than it is to build it over a long period of time. So yeah, you're absolutely correct. Speed of execution is important.
We're going to go off piste.
Cracking.
FOMO.
Yeah.
And so I've been giving it some thought over the last few years because it is so important in helping a round come together.
Yeah.
It's often sort of cast as being a not good reason for investors to invest. But actually, if you think about it in another way, if you've got other key ecosystem players who are participating in something, not just pooling risk, but also sharing reward and potentially opening up their network and helping make sure that that investment is a success,
Yeah.
then that's a great reason to invest and actually makes a lot of sense, right?
So something I was thinking about yesterday, someone said to me, "Oh, we're a value investor," and they were like Warren Buffett, and I was like, "No, you're not. Like nobody's like Warren Buffett. That's kind of his thing, or Charlie Munger." And yeah, most investors are not sitting down, going through mom and pop businesses in the middle of America, reading their reports and going, "I think I'm going to invest in that," which is what Berkshire did early days and was phenomenally good at it. That building consensus, there's other people in the ecosystem supporting it. There's potentially customers within the ecosystem. Like we've not talked a lot, but revenue and traction is always a good thing. And building that. And so FOMO it is important. It does work. It's sometimes a bit jarring when you've spoken to somebody months ago, they weren't interested. And now the round is closing. They're like, yeah, so like I always said I was going to invest.
Yeah.
You're like, no, you didn't, but I'll take your money.
Yeah. And then that's when you regret, oh God, everyone has to invest in the same terms.
Yeah.
Yeah, but I guess it makes a huge difference to founders, obviously, having that work in their favor. Unfortunately, it sounds like in this instance, it didn't. And we don't know what the external factors in terms of that VC angel program. But I would imagine that some of them sort of say, well, here are the deals that I'm considering doing.
Yeah.
And if they're a first-time angel and this is like essentially a training program for them, it doesn't surprise me that they might have got sort of cold feet and thought, actually, I need to make sure that I look good and I'm doing hot deals. I wouldn't count 2 months delay from the start of a round as being cold, but
the hot deals thing is interesting. So I'm aware of a fund who took a while to make their first investment, and the reason was that they wanted to make an investment that looked good, looked sensible, and you're going to be doing 5 deals a year or whatever the plan is. You just have to get on with it. No one's going to remember the first one when you're making the 20th. So just crack on, and start
pancakes,
moving.
Right?
Yeah, exactly. Yeah, 100%, right? And you're going to make a few mistakes. So what if the first one is a mistake? It at least signals that the shop is open.
Okay, all right. Let's. I think we must move on to voting.
Yeah, I'm not sure I'm going with this one. I kind of yeah. We haven't used all the colors, but I'm feeling like I'm on oddball on this.
Yeah, me too. I don't think you can understand it from an investor perspective.
Yeah.
And it doesn't sound like it was too bad for the business. Hopefully it wasn't like a big signal that the founder had used to attract lots of other investors in, which sometimes it can be.
Yeah, and again, back to our point that, any seasoned investor would just be like, oh, okay, this has happened. This happens. We're still fundamentally interested in the business. And also from a founder's perspective, you can't just rely on one investor. You need a syndicate. You need a team for lots of reasons. But this is one of the reasons: is there will just be some attrition before the round is even closed.
Yeah. Thank you very much. Thank you very much for being here.
Thank you both.